One set of earnings where, of course, the management is flagging off that there will be margin concerns. Let me now take it across to Sachin Tikekar, Joint MD at KPIT, to talk about how their performance has been. Sachin, hi, morning. Great to have you
Good
on the
morning.
show. You missed your full year FY26 margin guidance, Sachin. Your margins at 19.49. Which was actually guided for earlier as 21%. What led to this? And from 19.5 in FY26, what makes you confident of achieving EBITDA margins in the range of 20.5 to 21 and a quarter?
Oh, no, great questions. Let me just clarify. The EBITDA actually stands at 20.6, and it was 21.1 last year. So yes, we didn't quite make it to 21%. Essentially, what has happened is, we did take a little bit of a hit on the wage code part. But overall, the transition has been from fixed price to more AI-infused solutions. That means we ended up cannibalizing our own business to some extent. And that does have implications on margin in the short run. But at the same time, that really gives us the confidence that going forward in the midterm, we should be able to expand our margins. So we feel pretty good about the progress that we have made with AI-infused solutions. We've been working on our platform called Beacon for 2 years now. Last year, we piloted this platform in 3 specific clients. And, anything new, you go through some rough weather. But the point is, it does hold tremendous promise. So we do believe that over a period of time, the margins will get better.
Okay, understood. So that's your outlook on the margins. Mr. Tikekar, in the press release, you've said FY27 looks more promising than FY26 in terms of revenue growth, visibility and market opportunity. Can you elaborate on this? Help us understand which triggers are making you believe that FY27 is going to be better than FY26?
Absolutely. It's a great question. And let me take you back to the journey that we started, where we started to build for resilient growth. Given all the macro things that are coming at us and some of the micro things that are coming at us, we started to work on resilient growth, anchored on 3 things. So in our existing clients, how do we really increase our wallet share? Second was, how do we add new clients that can be strategic to us in future? And third is to look at specific growth markets like India, China, and Southeast Asia, where we can offer very specific go-to-market that makes sense for the market. We made tremendous progress on all 3. There is still more work to be done. This has been a year and a half kind of a journey. Along the way, of course, there have been some unexpected punches, both micro and macro, but we are rolling with those punches. And we do believe that in the next couple of quarters, we'll put a solid framework. The framework will actually come in place that will give us a solid foundation for ongoing growth, not only in the second half of the new financial year, but in the midterm, the next year and the year after.
But Sachin, you've also pivoted towards the domain and AI-led products and solutions segment as well, right? Tell me how much incremental revenue do you aim to generate from AI-led products and solutions in not just 27, but FY28 as well?
Yeah. So, last year, I would say the products and solutions contributed to about 15% of our business. So 85% came from services. Our goal by FY29 is to have more than 65% coming from products and solutions and only 30 to 35%. So that's a huge transformation for our clients as well as for us. And we are betting big on this.
Okay, so that sounds good. And also talk to us about the strategy to expand your business presence in key markets like India, China, and Southeast Asia. Why these geographies particularly, and what's the growth potential there?
Absolutely. So first of all, our bread and butter will continue to come from the US, Germany, and Japan. Absolutely no questions about that. However, from the growth perspective, we do believe that the India growth story, the micro-mobility story here in India, the deep tech story in India, where we can leverage our existing core competencies to provide market-specific solutions. Now, As you know, there are more and more India OEMs that want to get into passenger car and trucks and so forth. Some of them are actually buying platforms from outside. I don't know whether you heard about an announcement from GSW where we'll be their partner to integrate a platform from China. We'll see more and more such opportunities coming in India going forward. Micromobility is another area where we can extend our capabilities. So we believe that India is going to be a growth market for us starting this year. Same thing in China. Started making investments in China 2 years ago. We have signed up with two OEMs there, and we believe that our products and solutions, not the services, will make a difference in China. Southeast Asia is something for tomorrow. We are investing in Southeast Asia right now because we believe what will work in India for us can be extended in Southeast Asia. In terms of micromobility, also the Chinese companies who are setting up their base in countries like Thailand and Vietnam to have access to the rest of the world. So we also look at that as an opportunity coming from Southeast Asia. So, given this, we believe that these three specific regions will contribute to our growth significantly over the next 3 years.
Okay.
But Sachin, just wanted to understand, I mean, what's that one thing that you would like to tell your shareholders, I mean, who are still hoping for that 52-week high of, double the current market price? What's your one message on why they should stick by with the sector where you know there are a lot of headwinds in place?
Absolutely. So first of all, KPIT continues to be, in the eyes of vast majority of the OEMs, the most strategic partner. This is absolutely, and in terms of SDV or SDM, we continue to be leaders. There are glitches along the way that we have seen along the last 3 years, both micro and macro, and that's just part of the game. So the strategy is actually unfolding really nicely, which I just described, building resilient growth. And some of that is visible. Just to say, in terms of the wallet share, we've increased our wallet share in our existing clients by 10% this year. We plan to increase that by 20% in the current year. So, the results are sort of becoming more visible. The second part is we've added 13 clients across passenger cars, trucks, and off-highway across the 3-4 geographies that we serve. So we have started to sow seeds for growth, and we have never added 13 clients in the history of our company. So that's something that is different for us, but we have done that. And last but not the least, I think there is a compelling strategy that we are unfolding for the growth countries like India, China, and a region like Southeast Asia. So, we always make bets for the midterm and long term, and we are taking huge bets, where our investment, on an average, most companies invest 1% in their R&D. We have been investing 3%, and it'll go up to about 5% in the near future. So, we are betting big on ourselves, and I think, rest we'll see as things unfold.
Okay, understood. Mr. Tikekar, also give us a sense on your SDV programs. As I understand, two of your largest SDV programs are concluding in the first half of FY27. Some analysts believe that this could have led to a 4 to 5% sequential uptick had these continued. So talk to us about what the impact of this culmination could be. And on the flip side, could this be covered up by the growth in new accounts? What could be the balance there?
Absolutely. So one program was designed to come to fruition, and that vehicle will hit the first generation SDV program in the next 3 to 6 months. So we are very proud of our contribution towards it, and we'll see a successful SDV launch. The second one was a bit of a surprise to everybody. A specific OEM decided to cancel all their EV programs and took a charge of $15 billion just a few weeks ago. So that was unexpected. And this happens to be one of our largest clients, if not the largest. So that was a bit of a surprise to us. Having said that, it is what it is. So we were hoping for growth in H1, but some of the growth through new clients will compensate for this. However, we may not get substantial growth coming our way in the first half. But it also tells you it will the two programs will be behind us during the first half of the year, that means the second half looks a little more promising as compared to the first half, because the growth momentum across the new accounts continues to build. So we feel pretty confident about getting back to the growth in the second half of this year and in the next year.
Okay, sounds good. Good luck for that. And Mr. Tikekar, we hope to interact with you once again as well. Thanks so much for your time.
Thank you for having me.
Okay, viewers, it's time to slip into a very short break. Just taking a look at where the market has settled in about 20 minutes into trade. Absolutely flat move for the Nifty right now. We're slightly under the 24,350 mark. So we've seen a little bit of a cool off since market open of about 20 to 30 points roughly. That being said, autos and metals continue to gain, but you have some pressure on realty and FMCG along with IT and PSU banks. But on that note, we'll slip into a very short break. More management's conversations lined up on the other side. Stay tuned.